All right, everybody, welcome back to Real Estate Today. Hitting some really cool topics with you. And I'm one of your hosts, Jeff Beggins, here with my brother,
Craig Beggins.
Craig
Hello, everybody.
and right below me over here is our brother from another mother, Mike Puma. All right, 3 topics today. Real relevant. What's going on in the market today? We are in the late September 23, just to bookmark this, which is interesting. So we're going to talk about rates. We're going to talk about what's happening. We're going to have a little bit of debate about where things are going market-wise over here. Then we're going to switch topics, talk about insurance and some of the major issues. I'm going to talk about some real relevant stuff with some flooding problems that we've had on the Florida coastline and some insurance problems that are coming along that and what opportunities and challenges are coming with those. And then we're going to talk about how the market's changing and has changed, but not a lot of change with it, and the need for good marketing and different strategies there. So those are the cool topics we're going to hit today. So guys,
we're also going to hit debt.
And debt.
Which is a real issue that we need to talk about.
Forecast and consumer debts and how that's going to impact our markets here. So topic 1, guys, let's talk. So rates. We started talking earlier. One of the loan officers I was talking with last night, she was going to quote a new project for a buyer of ours. And she says, I'm not doing it tonight. I'm going to send it over to you tomorrow morning because I'm going to be able to lock in lower because the Fed didn't raise their rates. We internally are just going to drop our rates and we're going to be back down into the mid upper 6s. So I'd rather quote him there with a lock rather than in the 7s where we are. So that set a cool stage for me. What do you guys think about that?
I think that we could be seeing a moment like we saw right when COVID and the pandemic first started, right? Where people kind of hit the pause button, not the stop button. And then I think there's a big difference, right, between hitting stop and hitting pause. A lot of people, when COVID first came around and the pandemic first came, was, hey, pause, what's going on? All right, let's take a step back. And we all had this moment of, is everything going to hit the fan here or what's going to happen? And no one knew. And then all of a sudden, everyone realized, wait a minute, okay, there's a lot of opportunity here. Rates dropped. Everyone went go. And we could be seeing that again. I think everyone, when the rates started creeping up into the 7s, everyone hit the pause button saying, wait a minute, what's going on? And now we could be on the verge of us hitting the go button again. Question is, are we going to be ready for it? And if you're an agent or you're a buyer and you're not ready, even if they do continue to drop, even if it's significantly, and I would consider significant, if we get back into the low 6s, upper 5s, I think that's really solid rates that we're going to have for a good period of time. If you're not ready to take advantage of that, you're going to miss the party.
I think it's bigger than this, right? I'll just tell you from my perspective. Last night, right, getting off the phone with her. And for me, it was really big because we're sitting in this time where we're bombarded with media, with news articles, with all kinds of stuff. You can find doom, gloom crap all day long. Inflation's not under control. Elections are going on. We have problems. We've got bank collapses. We've got failures. We've got all kinds of stuff. All this uncertainty is so easy to attach to, right? So it's so simple to say, we're not there yet, right? It's not fixed yet. The rates are still going to go up. The Fed even said, right, we're going to keep raising them until we get to 2% inflation, which probably is never going to happen, first of all. So that just creates where is the uncertainty going to go? So for the fact that the pause happened, this is pause number 2, right? We had 14 straight raises or 13, 14 straight raises, and then this is pause number 2, not in a row. But I like that because that means that there's good news. The stats and the numbers are coming back. That says we're not falling over a cliff, right? We're not going to keep going. It's not going to shut everything down. Because, guys, I could tell you, Craig, you know it too, there's so many projects that have been shelved because financing costs are just too high, right?
Yeah,
just
margins away.
Too high. Just takes all the margins like, screw it, I'm not doing it, which has a huge ripple effect with employment, city income, all kinds of things that flow downward from those decisions. So now you're starting to say, okay, it's not over. We're going to have some fun again, or maybe it looks like we're going to have some fun again. So now people are going to start putting their head out of the hole and go, hey, wait, this might not be so bad. So I think consumer confidence drives it all. So for me, it's huge. To your point, Puma, this could be the defining moment of turning it back.
And before Craig dives in, the other thing that I thought was really interesting that I saw this morning was you had a lot of the big tech companies and retailers like Amazon who hired a ton of people during the pandemic. And then you saw all these articles about layoffs. Oh, Amazon laying off 2,000 people, 5,000 people, 10,000 people, right? Guess what Amazon just did? They just hired 250,000 people.
I was going to say you got to measure it at scale.
Why would they hire 250,000 people after just going through a period of cutting about 10,000 jobs? So we cut 10,000. Media wanted to go bonkers about, oh my God, Amazon's cutting all these jobs. They just hired 250,000 people. Why?
Right? I want to know where they found them.
So that's just something that tells me that they're projecting something that we're not, right?
Yeah. Well, I'm going to be the doom and gloom guy. If you guys are waiting for interest rates for mortgages to be 3% and 4% again, forget it. You'll be lucky to get in the 5s. That'll be an interest rate funk if it goes to 5. The 3s and 4s, I'm sorry, you missed the game. We told you, generationally low interest rates. I'm happy to have my 3%. I'm good. You're never going to see that again. So you got 5 and 6s, Jeff. You disagree with me on that? That's fine. I just don't think so. But it really doesn't matter. What we have is a combination of home prices have gone up. I mean, shit, a $200,000 house is now $400,000. Somebody needs to talk to me. So you take a $200,000 house at a 3% interest rate versus a $400,000 house, same house, at a 6% interest rate. It's a whole different world, right? That's the world we're in. I talked to one of my daughters and said, look, I'll help you buy a house. She says, I can't afford to buy a house because where I'm living is nicer than where I could live. Because she's paying rent, subsidized. But it's not going to happen. It's tough right now. Yep. It is hard. You have to qualify. But the benefits, if you look at my Wizard article from this month, which will be in all of our agents' e-blast, it is what it is. The benefits of homeownership still outweigh the benefits of renting. What do you get? You get mortgage interest tax deduction. You get to write off your income, your interest income. You get a stable fixed interest rate. Your rents are going up every month. Look at rents. Jeff, I don't know. I told you about this market. We have 1,600 apartments being built right around Apollo Beach. And they start for a 2.2 at $2,000 a month.
Oh, yeah. And you've got build-to-rent communities. They're just building new ones just to rent them out.
But
there's no benefit to renting. There's none.
I do think that's the piece that's missing, though, Craig. To your point, I think, unfortunately, when people think about homeownership, they really only look at how much do I have to put down, how much is my payment, right? They're just doing that piece of it, which obviously is an important piece. But the reality is it's the whole thing. And I don't think we ever really are taught that or look at it that way. But it really is a big picture, because even when you go, if you ever have talked to a financial advisor, right, what do they look at? They're looking at how much income do we have? How much debt do we have? Where are your investments? What do we have cash on hand? What do we have asset-wise? They're looking at the whole picture and then making decisions based on that. They're never going to look at just your bank account and be like, okay, well, based on your bank account, we're going to go on this. They're going to say, okay, well, where's your bank account? Where's your income? Where's your future income? How much debt do we have? They're looking at the whole picture. And when it comes to homeownership, we need to look at the whole picture, because it's not just what you can afford. It's also, what are we giving up, right? What if I don't do this? Everyone's like, oh, can I afford it? Can you afford not to do it? Can you afford to give up that wealth, right? Can you afford to give up those tax deductions? Can you afford those things? And that's where I think the mind shift needs to happen.
Well, I think there's an emotional component too. I want to paint my daughter's bedroom yellow. I want to paint my son's bedroom, not to be gender specific, blue. I want to put plants in the yard. I want to put a hammock between the palm trees. You can't do that in a rental. I mean, the pride of ownership, and that's why it shows. There's study after study that shows that people that live in homes that they own are more stable than people that live in rentals, because they're going to move every year, and every year the landlord could raise the rent. And if rates keep going like they're going, what's going to happen to rents?
Right. Well, let me give you a good example on this one. So one of the houses that one investor group is interesting point to drives your point home, Mike. So a friend of mine's doctor sold his practice. He and a bunch of his other doctors, they owned the practice. They sold it. They cashed out really, really well. And they're looking now, sitting back, and they've got a bunch of money in their accounts. And they're like, where should I put my cash? Right. And I love the fact that they're talking with me about it because, I mean, it doesn't matter if you do something with me or not. I'm going to give you my advice on how I would look at it. And this is what I would do. Right. So we're looking at he's looking at three different things that I'm involved in right now about getting involved in them. And then one of them, I said, you got to look at the big picture, right, Mike? It's not just the home. It is this it's one of the Pelican homes, right, Greg? So it's a $3.895 million piece of property. And he's going to finance it, or is he not going to finance it? He could pay cash, or he could finance it with 25% down, or 50% down, or 60, or whatever he wanted to do. So the analysis is there. Right. So it's not just that. Then this particular home is going to probably bring in $500,000 a year in gross income from a rental perspective. One home, right? It's a big home, 9-bedroom house. So on that. So now
Aggregation analysis and all this other stuff.
That's what we're doing. So it's not just the $500,000. It's the fact that the estimate is he has to talk to his tax advisor again. But the advice I got from ours was that there's probably about $450,000 depreciation first year in that piece of property. And then it's a $4 million piece of property, rounding up, right? And it's going to appreciate, just go conservative, 3% a year. We're doing that a quarter right now, right? 3%. There's another 140 grand a year in appreciation. There's 450 in depreciation. There's $500,000 in income. So how does that all wrap in together to go against the down payment, right? And then what's the ROI, the true ROI, because it's a leveraged ROI if you're going to finance it, right? So what's your cash on cash return and what's your payback period? All those things are running into their decision funnel to figure out what they should go do. And so that's interesting. So to your point, Mike, that's it. You got to wrap the whole picture. And we don't, as an industry, really do that well. Because if you say this is your payment, but this is your monthly deduction on average for what you're going to get on your write-offs from your taxes this year, right? So really your net cost per month is this. That would be an interesting marketing strategy on a piece of property to show renters versus buying. And if you were to buy what you're paying for rent, or even 1.5 times what you're doing, this is what your net monthly gain would be. That's interesting play there.
No, it's fantastic.
So it's right. So I'm excited because psychologically a dip down means that we're not going off a cliff. And so I know that a ton of people in my sphere, my neighborhood, industry that are just not moving because they don't want to trade their 3 or 4%, 5 and 4.5%, 5% interest rate for a 7 or an 8. Right? Certainly not an 8, not a 7, but a 6 maybe, and maybe a 5. Sure. Now it's reasonable again, right? In short term.
My favorite thing that we have as a company is our hot sheet that comes out every day.
Mm-hmm.
Yesterday's hot sheet came out, and we had 12 contracts and 3 listings. And I look at the agents and I look at the numbers, and I love that report. I just look at it. But fundamentally, we had 3 new properties come on the market, and we took 12 off the market. Yep. Does that signify anything? We're selling 4 times more houses, and we're adding to the market. And we're a big company. You know, this is from Miami to Clearwater. We took 3 listings, and we took 12 properties off the market at prices that are double what they were a year ago.
Yep.
So I think switching gears now, because our time is running low, we need to talk about that, right? There's a matter of greed, and I hate to use the word greed, but there's sellers that are trying to take advantage of a market, and there's agents that don't have experience enough to talk about the real market. So it's almost like a profit taking. Well, I bought my house for $200, but it's worth $800. No, it's not worth $800. It's worth what it is based on what else is available at the time you decide to buy. And we have to work on that with our salesmanship, with our agents and our consumers to make sure they're studying the market, not just profit taking. Right?
And it's tempting. It's super tempting when you see the neighbor sold for.
Oh, let's throw it up there and see what happens.
And I don't
it costs money to do that. We don't just throw a thing on the market. there's a $400,000 a month marketing machine behind this company that a portion of that goes to your listing. And if we don't get a return on it, a listing is an interest-free loan that we give a seller that only gets repaid if we sell the house. So we've got a lot of agents that are out there taking listings that are never going to sell, that we have to market and invest in, that we're never going to get paid back on. Right? And the strategy is put it up high and then bring it down, bring it down, bring it down, bring it down. But that's not a great strategy, right? Because I'll tell you, we've got many examples of properties we put on the market at market value and they sell above market. If you look at the hot sheet I was just talking about, you'll see listed at 489, sold for 502.
Yep.
Sweet. We hit the sweet spot. You put it on at 510, it's going to sit there for 6 months and it's never going to get topped. So there's really a strategy behind pricing a house and putting it on the market. And that should be a collaborative effort between us, our agents, and our sellers to make it happen. Because
Right.
the market is, we'll sell anything that comes on the market if we hit it right. But there's a strategy.
That's right. It's all supply and demand on that.
Mm-hmm.
Let's talk about insurance for a minute and what's going on recently, because we've got some big changes going on. And what I'm doing tonight, we're doing a big seminar for our whole kind of region that had some impacts from Hurricane Idalia, right? And previous storms too. And it's a big topic about insurance. And there's a couple of big things. Craig, you and I were talking the other night.
It's huge.
We were talking about the difference in the national flood insurance policies versus the local carriers and how the huge differences in insurance, right? As far as elevation certificates, how high your house is above the ground. Before we get into that, I was just talking with a contractor this morning who actually goes under homes with steel beams, jacks up the steel beams and lifts the entire house up above base flood elevation. FEMA's given money out to go do this, right? And if you don't want to wait for FEMA money, you can get SBA funding for 2.5% to do it yourself, right? Now, there's a couple of unscrupulous contractors running around screwing people, and that's what he and I were talking about today. Because it's not good, right? And they're bait and switching, and this is not a cheap process. This is very expensive to do. It's probably about $110 a square foot of your home just to lift it up, and then you've got $50 to $75,000, depending on the house, of your structural foundations, like the pilings you need to put on to put the old house back on top of the new foundation. Then you need stairs, then you need plumbing, then you need electrical hookups, then you need a driveway, then you need no irrigation, then you got to put your sod back, and then you got to stucco the outside, you got to paint it, you got to do all that stuff. It's a couple $100,000, right? Plus, right, just to do something like this. But it's happening all over the place. So he's like, I can't even keep up with it. I've got probably 60 homes I could do if I had the crews right now. And it's amazing, but it's a big problem. It's a big problem because people are now wondering, what the hell do I do? And then you have insurance companies that he was talking about from down in Fort Myers, just a little bit south of our market. Obviously, huge impact from Hurricane Ian last year, right? Or 2 years ago now. And there's still huge ramifications going on down there right now. But that one, he was telling that all the insurance companies now have slipped in a clause inside the policies down there that has an exclusion for rising water coverage, right? And so no, that damage was caused by rising water. We're not covering that.
Well, that's what flood insurance is for.
Yeah.
Flood insurance is for rising water. Your hazard insurance policy does not cover that, period.
Yeah, but there's a lot of kickbacks on floods right now too. A lot of policies, people having to hire insurance companies or attorneys to fight their whole battles right now. So, but what's that going to do? So what's the difference between private carriers and the federal?
And you guys voted me down on this, so I'll take that beating.
On what?
But I wanted to not put a listing on the market until we had a flood quote, a hazard quote, a property tax quote. All these things are changing so much, right? My property insurance was $4,900 a month. I've got a nice house, right? My renewal is $9,000 a month. I did nothing wrong. I had no claims. I had nothing. They doubled my friggin' insurance, and everybody I talked to got doubled. My flood insurance, I happen to be in a 12-foot floodplain. My house is 18 feet. I'm never going to flood. FEMA sent me a bill for $8,500. My last year's bill was $1,100, but they gave me a $7,000 credit. So now it's $1,400, right? Not a big deal. I can afford $300 a month or $300 a year, but next year it's going to go higher and higher and higher. So what they did, FEMA, the Federal Emergency Management Act, has changed the basis point, and it's not based on your flood elevation anymore. It's based on your proximity to water. And that's huge. So a poor buyer, I don't mean to say poor buyer, but a buyer coming into our marketplace that's using the current seller's flood insurance and property taxes, it ain't going to hold for them because they get reassessed on January 1 at the new value. So the seller's been living there for 10 years in Florida, thank God, has this thing called portability where they rate you and you can't exceed more than 3% a year. So let's say I paid $400,000 for my house. I've lived here for 20 years. It's only worth $586,000, but it's really worth $1.6 million. So the new buyer is going to get assessed at $1.6 million. That's $22,000 a year. That's a big number. And then my flood insurance is what it is, but it's going to be more than double. And that's the biggest problem because it's PITI, principal, interest, taxes, and insurance is what makes up your mortgage payment.
That's right.
Those four things. So when your taxes and your insurance double, it makes it a more of an affordability crunch for the consumer. And we can't, in good conscience, as real estate brokers, not tell the consumer. So I wanted to put a move afoot that said, hey, guys, I want you to tell up front what the flood insurance is going to be, what the hazard insurance is going to be, what the taxes are going to be on this house, or we're not going to put it on the market. And we decided collectively as a group not to make that a uniform commitment, but which I'm not happy about, but it should happen, right? That's part of the bargaining of the property. I don't want to screw a buyer and find out that they can't afford the house later. We're just pushing a foreclosure down the road.
That's right. Well, that goes into the other topic we're going to talk about as far as good marketing, because the right thing to do, Craig, is exactly what you're talking about. And so is the whole certified pre-love program in general, right? So let's talk about marketing. Let's be honest. The last few years, right? This last year has been normal real estate market, but the couple post-COVID years, they were not normal.
They were great.
They were crazy because it was order taking. You had multiple demands on every property, and people were overpaying and doing all kinds of stuff just to get homes because there was a musical chairs game going on, and there weren't enough chairs for the people dancing. So people were grabbing whatever they can grab at whatever cost just to get in, right? So that's what we have now. Now here we are back in a regular 2019 world, right? And a regular real estate market, right? Back in 23. We're done with that craziness, and we're back to reality. But too many people forgot about what it takes to be good marketing on this one. So let's describe certified pre-loved, the concept, and what do we recommend? If I'm a seller, tell me what I should do to be the most attractive home on the marketplace. And let's go from a psychological standpoint, from a marketing standpoint. How do I become the most attractive piece of property on the marketplace?
I think it starts with full disclosure, right? We're a full disclosure state. You have to disclose anything you know that has material that affects the material value of property, right? So why not let the buyer know, here's what your insurance is likely going to be. Here's what your taxes are likely going to be. It all factors into everything, right? My daughter just bought a house, and we talked about this a little before the show. We hired a home inspector, and the home inspector did a shitty job. He said he couldn't find the fireplace flue. Well, I went to my daughter's house on Saturday. It took me 30 seconds, and I opened the flue, and it was fine. It was great. But he said he couldn't find the sewer taps where the sewer line runs to the sewer. And, they were found by the time I got there. But guess what they found when they got there? This is a 1957 house. The roots had and the trees had covered the thing, and we've got to replace the sewer lines now. It's a $4,000 expense, right? So there's so many details that have to be looked at that takes an experienced agent to understand how to guide a seller, and it's going to cost money, right? You're going to have to hire a plumber to get a scope and send the thing down there. It's like a colostomy, right? You got to go check it out and see what's going on, and it's broken. And now we got to dig up that entire line. There's two, because it was built in 1957 and addition in 1970 something. Both of them are collapsed. The home inspector noted on the inspection that the draining was slow. Well, no wonder it's slow, because the friggin' line is cracked, right? $4,000, right? And so buyers come in and they expect that a house is going to be good, but they don't spend the time to investigate it and ask. And the agents don't spend the time to question what's going on. There's a lot of stuff that happens in buying a house, right? This particular house had mold too. So we got another $4,000 mold remediation expense we're going through, right? That should have been identified by the home inspector. So just because you have a home inspection doesn't give you a clear pass. The home inspector missed the mold. We had to cut off half of the drywall in this house, half of the drywall. That means it's got to be seamed, it's got to be textured, it's got to be painted, it's got to have all the trim replaced. You know, there's an extra $100,000 in shit we had to do to this house, which wasn't budgeted, right?
I think though a lot of what you're saying is after a buyer comes in. I think from a marketing perspective, though,
Exactly.
there's a lot of work that has to be done well before we even get there, right? And this
It's a
is
matter of
not
consciousness, right? Does a seller want to pass along consciously a bad house? No, I don't think most do. But the right thing to do is to inspect it correctly and find out what's wrong, and either do one of two things: correct it or disclose it. Hey, if you're going to buy this house, plan on ripping out half of your drywall, retexturing this, it is what it is. Or fix it and sell it as a new house. That's Pollyanna, I guess. But I'm sorry, that's the way that's why we've been in business for 33 years and have never had a lawsuit, right?
yeah.
We want to disclose what's wrong with a house, but it takes the seller's cooperation. And sometimes we have to tell the seller, sorry, I'm not willing to represent you.
And certified pre-loved is certainly important in a marketing tactic, but I think right now, especially agents are going to find that, a couple of years ago, you put in the MLS, put a sign in the yard, and you're going to have 7 showings immediately. That's not the case in most of our markets, right? Despite inventory being low, there are just less buyers looking around, and there are more and more buyers that I'm seeing unrepresented, that don't have an agent looking in the MLS for them, right? That they are literally going to open houses. They're doing their own research. I saw a stat yesterday that came out from Soci that 50% more leads are being generated right now for real estate on social platforms than they are on MLS websites.
Wow.
50%. So you have a lot of people doing their research and their discovery via social and other methods. So if you, as an agent, are not properly marketing a property right now, there's a good chance it's not going to be seen by as many people, right? And then the ones that are you taking the extra steps? Are you doing your reverse prospecting? Are you sending out emails? Are you communicating with other agents? Are you doing the things that you need to do? Now, that's all the actual marketing execution. I think your point is, what product are we marketing to? Because that matters as well, right? I can buy ads and market the hell out of anything, but if the product that I'm marketing isn't good, right, then that's a problem too. And so both have to be on point. You got to have a really good product, which means that home is the product in this scenario. That's got to be good, right? And that's got to be up to par. You have to have a good package to present. But then you are going to have, my bigger point here is, as an agent, you're going to have to work right now. You're going to have to get good at really pushing the property out there via content, via social, via all those things. And you're going to have to actually become a marketer when it comes to getting property sold. It's not just as easy as putting in the MLS and putting a sign in the yard.
I had a conversation with two agents the other day, and the particular house you're talking about is absolutely drop dead gorgeous. These people have done a number on it, but it hasn't sold in 117 days, right? And I asked them, I said, what's the condition of the roof? We don't know. Well, you better damn well figure that out, right? At the point, we thought it was the original roof of 1972, but it turns out it was a 1999 roof. But still, 1999, this is 2023. It's not going to pass inspection, guys. The insurance company's not going to insure it. So, right or wrong, the roof's not leaking, but it's going to need a new roof. So there's $20,000, and the buyer is going to go into what we use as an as-is contract, and they're going to do an as-is contract. And if they're smart, they're going to get an insurance quote before their inspection period, and they're going to find out it's not insurable. I want to take away the problem of the discovery during the as-is inspection period. I want to make sure, hey, what am I going to find out about this house that I can't afford? Well, when you find out that it's not insurable and you're on a budget and you can't afford more than $2,200 a month, well, all of a sudden a $20,000 roof is a problem, right? I'd rather know that up front than put it under contract and then cancel the contract, because that costs us money, right? We go under contract. Our staff takes steps, our agents take steps. There's money, there's time, all that stuff happens, and then it cancels. And then we put it back on the market, and we learn a lesson, and we end up selling it for less because the problem was there. Let's identify the problem up front, and people don't want to do that.
And there's solutions for the problems too, right? Had you known that there was 60 grand worth of stuff that needed to be done to the home, we could have got you in a different loan program that financed those where that work into it. They didn't have to out of pocket. So the problem that I see with this one is buyers buy with emotions and they justify with logic, right? So when we're putting a product on the market in the open marketplace against competitive products, those who have the best emotional appeal are going to win, right? So you need some strategy and some sales tactics here, because when a buyer walks into my home with full transparency, Greg, you talked about, I have to say, here's my home. I did an inspection. These are the things I found wrong with it. Here's my receipts from my contractor who fixed it. Here's my re-inspection that shows that they're fixed. Here's my flood quotes. Here's my insurance quotes. Here's my utility bill. Here's my lawn bill. Here's my pool guy. This is everything. The house is in great shape, and it is what it is, and I think you're going to love it here. And this is what it's really going to cost you, and here's a loan program that will qualify you. Right?
And that's worth money.
Big time.
Big time.
I invested
That's called marketing.
maybe $500,000, right, to get the handyman to change some soffit and some screw on some light covers and the stuff in my home inspection report. But man, did I make a lot more money, because I can command trust and the emotional connection with the buyer that's going to make me the most attractive property on the market.
It's not even commanding trust. It's removing fear. Oh my God. This seller he's changed his AC filters every month for the last 20 years. I do that. I mean, my house is perfect.
Yep.
There ain't nothing wrong. If there's something wrong, it's fixed immediately.
Well,
That's more to somebody buying the house than somebody who says, sorry, as is, I don't know anything about it.
Well, and I think a lot of times the nicer the house, the more the fear is, right? Because as you're walking around it, you're naturally going, this is really nice. What's wrong with it, right? Why are they selling? Well, there's got to be something wrong. Someone die here, right? Like, I mean, these are the things going through someone's head. And I honestly believe the nicer that house is, the more they're going to be skeptical of why is somebody selling this, right? And why are they leaving? So I think that's important to remember.
The story behind. No,
That's right.
I've lived here for 23 years. My children are grown. We don't need a 7,000 square foot house anymore.
Yep.
Yeah.
That's it.
Very good. Well, good. Well, we could go on and on with topics for days, because we've got a million of them in our head. But that is the end of this episode, guys, and hope you got some good content out of this one, and tag some agents who need to see this, because we're going back into the party, guys. I'll call it. I'll throw it out there. The consumer confidence just shifted, and we're going to get people picking their head back up. You're going to watch your showing time stats. Watch things start going up. We're going to start getting more views on properties. Sellers are going to start looking around at what's going on in the neighborhood, starting to call agents to get us CMAs. What is my home worth? We're actually thinking about moving now. rates, I think, are going to go down a little bit more. So we're going to be ready, right? So that's what's happened is I believe this is the moment activity is going to start. And I think we can throw the little place marker out that we're in great shape. So
I actually read a forecast yesterday that said that the pre-winter selling season is going to be better than it's ever been before.
there we go.
I choose to believe that. So let's let it happen.
And we decide if that's going to happen or not by our work ethic on how many people we're going to talk to. Because, guys, we have to share the truth. And the truth is what's going on, right? And our version of the truth, if you will, right? Because we read the real stats, not the media bullshit, and talk about what's really going on in the market. And the market really is consumer confidence and buyers and seller sentiment. And nobody's got a better pulse on that than us who are in it every single day.
Well, look at our hot sheet. We had 3 listings yesterday. We had 12 contracts. So we added 3 properties to the market, and we took 12 off the market. Inventory shrinking.
There we go.
Supply and demand. All boils down to that.
Thank you for watching. See you on the next episode. Thanks for tuning in.